When markets recover this quickly, most people do not feel clarity, they feel confusion. 1 month ago, the mood was fragile, stocks were weak, Bitcoin was under pressure, war risk was rising, oil was high, inflation was not solved, people were waiting for the next bad headline. Then, almost suddenly, the S&P 500 and the Nasdaq completed something close to a full V-shaped recovery. Bitcoin moved from the mid-60s toward 80,000. The same investors who were afraid to buy began to feel that maybe they had missed the move. That is how markets work. They do not move after the average person feels comfortable. They often move while the average person is still trying to understand what happened. This is why investing is so difficult. The market is not only a reflection of reality, it is a reflection of expectations about reality, expectations about policy, expectations about earnings, expectations about war, expectations about liquidity, and expectations about what other investors are about to do. That makes markets emotional machines. Human beings create them. Human beings are fearful and greedy. Human beings overreact. Human beings underreact. Human beings chase. Human beings panic. Human beings want certainty where certainty does not exist. So when I see a market rally like this, I do not say everything is fixed. I also do not say the rally is fake and must collapse tomorrow. I ask a better question: what changed and what did not change? That distinction matters more than almost anything else right now. What changed is that the worst-case fear around the US and Iran conflict was reduced, at least temporarily. A ceasefire extension gave investors enough comfort to step back from the most catastrophic scenarios. Markets had been pricing some probability of a broader shock. When that probability fell, risk assets rallied. That is normal. Markets dislike uncertainty. When uncertainty declines, even briefly, prices can rise. Strong corporate earnings also help. The S&P 500 is not only a war headline, it is a collection of businesses. If companies continue to earn money, maintain margins, and guide with confidence, investors have a reason to buy. Then there is AI. AI optimism has not slowed down. New model updates, new infrastructure spending, and constant signs of progress keep reinforcing the idea that we are living through one of the largest technology transitions of our lifetime. When investors believe the AI trade is still intact, they are more willing to buy large U.S. technology companies, semiconductors, cloud names, and eventually the broader market. So yes, there are reasons for the rally. The ceasefire reduced immediate fear, earnings supported confidence, AI kept the future story alive. Bitcoin benefited from renewed risk appetite, but here is what did not change. The conflict is not fully resolved. Oil is still vulnerable to supply risk. The Strait of Hormuz is still a major pressure point. Inflation can return quickly if energy prices remain elevated. The Federal Reserve is not free to cut rates aggressively if inflation reaccelerates. The market has not escaped macro risk. It has only received temporary relief from the worst case fear. That is the key. A relief rally is not the same as a complete resolution. A ceasefire is not the same as peace. A bounce is not the same as safety. A V-shaped recovery is not proof that all risks are gone. The mistake people make is that they move emotionally from one extreme to the other. When prices fall, they believe the world is ending. When prices recover, they believe the danger has disappeared. Both reactions are wrong. Markets can rally while risks remain. Markets can fall while long-term opportunity improves. The disciplined investor must hold both truths at the same time. Right now, the rally has some rational basis, but it is also fragile because it depends on several things continuing to work. Oil must not spiral higher, inflation must not reaccelerate too quickly, the Fed must not become more restrictive, earnings must remain strong, AI optimism must stay intact, the geopolitical situation must not deteriorate into a broader conflict. That is a lot of conditions. This is why I would not treat this environment as a simple, all-clear signal. I would treat it as a market showing you how fast capital moves when fear declines. Even before the underlying risks are fully resolved, that creates an important lesson. If you sit entirely in cash waiting for the perfect dip, you may miss the upside. But if you chase aggressively after a fast rally, you may buy into a vulnerable setup. The answer is not all in or all out. The answer is a system. That system begins with dollar cost averaging. Dollar cost averaging is not exciting. It does not give you the thrill of calling the exact bottom. It does not let you brag that you bought the low and sold the high. But for most people in a wealth accumulation phase, it is one of the most rational methods available. You invest a fixed amount on a recurring schedule, weekly, monthly, whatever. Fits your life. When prices are lower, your money buys more. When prices are higher, your money buys less. Over time, you participate in the long-term direction of productive assets without depending on your ability to predict short-term volatility. That matters because the perfect dip is not guaranteed. Everyone wants the 20% correction. Everyone wants to say, I will buy when the market finally gives me the perfect entry. But markets do not owe you the perfect entry. Sometimes they dip and keep dipping. Sometimes they dip and recover before you act. Sometimes they never reach the level you wanted. Sometimes the best entry looks terrible emotionally when it happens, and sometimes the market moves higher for years, while the people waiting for a perfect crash slowly fall behind. If your goal is long-term wealth accumulation, being permanently sidelined is usually a dangerous position. The market has historically spent more time in bull market conditions than bear market conditions. The S&P 500 has finished positive in roughly 7 of the last 10 years across long historical periods. That does not mean the next year is guaranteed. It means that sitting out because you are waiting for certainty has a real opportunity cost. The left curve and right curve move may actually be the same for many investors. Keep investing DCA into assets with strong long-term asymmetry. Hold extra cash as firepower in case a larger dip arrives. That is a balanced approach. It allows you to participate if markets keep rising. It gives you dry powder if markets fall. It prevents paralysis. It reduces the emotional burden of needing the perfect call. This is especially important now because the world may be entering a technological transition that changes labor, capital, productivity, and wealth distribution in a way most people still do not fully understand. AI is not just another app cycle. It may change the structure of work itself. When major entrepreneurs, technology leaders, and investors begin openly discussing universal basic income, universal basic wealth, or government checks to offset AI-driven job displacement, you should not dismiss it as science fiction. You should ask why they are saying it. These are people building the machines. They see the productivity curve. They see the labor substitution risk. They see the possibility that a large part of the population may not have worked in the same way prior generations did. Maybe this future is 5 years away, maybe 15, maybe longer. The timing is uncertain, but the direction matters. If the people building the technology believe job displacement and government income support may become part of the system, then the ordinary person must ask a very uncomfortable question. Do I want to be only a consumer in someone else's AI economy, or do I want to be an owner? That is the dividing line. If AI creates massive productivity and most of the gains accrue to the owners of models, chips, data centers, cloud platforms, robotics, infrastructure, and financial assets, then the person who owns none of those assets may receive only a government allowance while the asset owners capture the upside. That is not a future you should casually accept. The goal is not to panic. The goal is to prepare. Preparation means owning assets. It means investing in the companies and networks that may benefit from the transition. It means diversifying across productive assets, Bitcoin, gold, international exposure, and growth areas. If those fit your risk tolerance, it means improving skills. It means understanding that financial freedom may become more important, not less. As labor markets change, money does not solve every problem in life. It does not create meaning by itself. It does not replace family, faith, health, purpose, or character. But money does solve many practical problems. It affects the neighborhood you live in, the school district your children can access, the security you have in emergencies, the options you have when work changes, the health care you can afford, the risk you can take, the time you can protect. So if the world is moving into a period where technology may concentrate wealth even more aggressively, then building ownership is not greed, it is defense. That is why this moment matters. There may be a generational wealth transfer happening already, not only through inheritance but through technology ownership. The companies building AI infrastructure models, chips, cloud systems, and automation may capture enormous value. If you are not participating in ownership, you may watch the transition from the wrong side. This does not mean buy anything with AI in the name. That is a mistake. Every major technological wave creates real winners and a huge amount of noise. The internet was real, but many internet stocks failed. Electric vehicles were real, but many EV startups destroyed capital. Crypto created real wealth, but most tokens went to zero. AI may be real and still many AI-linked trades may fail. So the task is not to blindly chase the theme. The task is to identify where the real asymmetric opportunity is. Asymmetric opportunity means the upside is meaningfully larger than the downside if the thesis is right, and the market has not fully priced it in. But asymmetry is not a slogan. It has to be built from several conditions coming together, a strong narrative before the crowd fully understands it, a real catalyst, liquidity that can flow into the asset, a price that has not yet fully reflected the future possibility, relative strength during uncertain markets. A clear mechanism for value accrual, a risk level you can survive if wrong. When those factors line up, the opportunity can become powerful. The source uses the example of identifying Aerodrome early because the base chain narrative was visible before the broader market understood it. Coinbase had laid out a plan. Base was emerging. Aerodrome was positioned as a decentralized exchange on that ecosystem. The attention and liquidity had a logical place to go. The market had not yet fully priced it in. That is the kind of setup that can create large returns. But the lesson is not to copy one old trade. The lesson is to understand the pattern. Narrative, attention, liquidity, upside, timing, conviction, risk control, and then, most importantly, exit discipline. Buying early is difficult. Selling is often harder. This is especially true in crypto. People talk about the entry because the entry feels heroic. But fortunes are not made until profits are realized or protected. A token can go up 20 times and then fall 80%. If you cannot sell when the market becomes euphoric, the paper gain becomes a psychological trap. So asymmetry requires two skills: the courage to buy before the crowd, the discipline to sell when the crowd arrives. Most people have neither. They buy late and hold too long. That is why the framework matters more than the coin. Now, before thinking about specific opportunities, we need to reduce information overload. The problem today is no longer that retail investors have no information. The problem is that they have too much. Social media produces endless threads. AI tools can summarize companies and tokens instantly. News flows constantly. Charts update every second. Influencers shout conviction. Data dashboards show on-chain flows. Research reports multiply. The average person is not starving for information. He is drowning in it. Information overload creates analysis paralysis. People receive so much data that they no longer know what matters. They watch every headline, every chart, every rumor, every token launch, every war update, every Fed comment, every AI release, and every price candle. Then they freeze. A good investor must filter. Right now, the filter should focus on the real needle movers. There are 5. The first is the Iran conflict. The market is reacting to whether the conflict escalates or remains contained. The worst-case scenario would involve a broader war, a ground invasion, major disruption to energy flow, or the Strait of Hormuz becoming a sustained choke point. The goals of the United States and Iran matter because they shape the likely path. The United States wants to prevent highly enriched uranium from becoming a greater threat, reduce missile capabilities, and keep the Strait of Hormuz open for oil traffic. Iran wants sanctions, relief, compensation, regional control, continued authority over its nuclear program, and reduced U.S. military pressure. These goals are not easily reconciled. That means the most likely path may be a messy middle. Not full peace, not full war. Tensions flare, isolated incidents happen. Negotiations continue in the background. Markets react to each headline, but the deeper conflict remains unresolved. That is why geopolitical risk has not disappeared. The second needle mover is oil. Oil is the fastest transmission mechanism from war to the economy. If oil rises and stays high, inflation pressure rises, transportation costs rise, corporate margins can be squeezed, consumer spending can weaken, the Federal Reserve becomes less able to cut rates, liquidity can be pulled away from risk assets. For a true risk, on bull move, oil usually needs to calm down. If oil stays elevated or spikes further, the market can correct quickly because the inflation path changes. This is why investors should not only watch the stock chart, they should watch energy. The third needle mover is inflation and interest rates. Markets love rate cuts because rate cuts reduce the cost of money. They can support housing, credit, business investment, and asset valuations. But the Fed cannot cut easily if inflation is rising because of oil and energy. A new Fed leadership structure may increase expectations for cuts, and markets often price rate cuts before they happen. Even the rising probability of cuts can push risk assets higher. But if inflation data worsens, the rate cut expectation can reverse. That reversal can hit stocks, Bitcoin, and speculative assets. The fourth needle mover is corporate earnings. Earnings have been one of the biggest reasons the market has remained resilient. If companies are still growing profits, margins are holding, and guidance remains strong, investors have a reason to buy. If earnings weaken, the market's support can weaken quickly. The fifth needle mover is AI optimism. The market is still heavily tied to whether investors believe the AI trade remains intact. If AI momentum continues, large-cap technology can keep pulling the market higher. If a major AI shock appears, like a low-cost competitor or a sign that capital spending is not producing returns, the market can sell off fast. We have already seen this pattern. AI optimism is a market support. AI disappointment is a market risk. These 5 variables are the filter: war, oil, inflation, and rates. Earnings. AI optimism. Do not react to every headline. Ask whether the headline changes one of these 5. If it does, pay attention. If it does not, it may be noise. This is how you protect your mind in a noisy market now. What is the current assessment? The war situation looks better than it did at the worst moment, but it is not solved. Earnings look strong enough to support the market. AI optimism remains powerful. Oil remains elevated and dangerous. The Fed is not fully dovish, so the market can grind higher if oil cools. Inflation stays contained, earnings remain strong, and AI momentum continues. But if oil stays high, inflation reaccelerates, and the Fed cannot ease, another correction can appear quickly. That is the balanced view, not permanent bearishness, not blind euphoria probabilities. Now, if you believe that over a 2-year, 5-year, and 10-year horizon markets will be higher, then you need some exposure today. That is the central practical point. Long-term wealth builders cannot sit entirely outside the market because they are waiting for short-term certainty. If prices go down, you buy more. If prices go up, you are still participating. This is how you ride the larger trend. The higher time frame matters. There may be more pullbacks. The bottom may not be in. Things may trend down again. But if the long-term direction of technological progress, asset ownership, and liquidity is upward, then being permanently sidelined is a poor strategy. This is why DCA plus cash reserves makes sense. Now, where is the asymmetric upside? The source moves into crypto because crypto is where the largest asymmetric trades have appeared in prior cycles. This is a high-risk arena. It can create extraordinary gains and severe losses. It is not appropriate for everyone. It requires risk control, position sizing, and an understanding that many assets can go to zero. But within that world, the framework is clear. Look for assets that held up better than expected during uncertainty. Relative strength matters. When something refuses to die during fear, it may be telling you that buyers are present. It may be telling you that smart money is accumulating. It may be telling you the narrative remains intact. It may be telling you that liquidity will return there quickly when the broader market stabilizes. Relative strength alone is not enough. It is one factor. You still need narrative, catalyst, revenue, liquidity, token economics, community, valuation, and risk. But it is useful because markets reveal demand through price behavior. If everything is falling and one asset holds up, ask why. That is how a watch list is built. Do not ape into everything green. Build the watch list, study the narrative, study the momentum, study the upside, study the downside, study the catalyst. Then act when the setup aligns. This is especially important because crypto liquidity is not what it was in 2021. Retail investors are more experienced. There may be less easy exit liquidity. Money rotates faster. Narratives explode one at a time, not all at once. If you are late, the move can be over before you understand it. That makes preparation more important. The right market conditions only appear part of the year. Most of the time, markets choppy markets, punish overtrading. The biggest money is often made not by trading constantly, but by waiting for the period when high time frame and low time frame trends align. This is like fishing. There are moments when the bite is on, the tide is right, the conditions are right. You can cast almost anywhere and the fish hit. Then there are long periods when you can do everything right and still get nothing. Markets are similar in the wrong conditions. Overtrading drains capital and focus. In the right conditions, conviction and size can matter. That means patience is not inactivity. Patience is preparation. The source also uses retail attention as a contrarian signal. When views are low and retail is bored, opportunity can be building. When views are high and everyone wants in, it may be time to manage risk or exit. Retail often arrives late. They ignore assets when the work should be done. They buy when the excitement becomes obvious. They sell when the pain is already priced in. The rule of thumb is not perfect, but it is useful. Do the opposite of the crowd, but do not do it blindly. Contrarianism only works when paired with a real thesis. Being contrarian without a thesis is just being stubborn. Now, what are the specific areas of interest in the source? The first is Bitcoin. Bitcoin remains the core crypto exposure. The thesis is that above certain levels, the broader structure remains intact. A zone between 60 and 70,000 is treated as attractive. A move toward 50,000 would be considered a major opportunity for someone with experience and risk tolerance. Above 80 to 82,000 could signal confirmation and early breakout behavior. The exact levels are less important than the process. Define levels before emotion hits. Know where the thesis remains intact, know where you want to deploy, know where you are wrong. When a level hits, you act according to the system rather than guessing in the moment. That is how traders reduce emotional decision making, but leverage is dangerous. The source mentions leveraging only personally and not recommending it to inexperienced people. That caution matters. Leverage can create outsized gains, but it can also liquidate you before the thesis plays out. A good idea with too much leverage becomes a bad trade. Bitcoin can be a core allocation for some investors, but it should be sized according to risk tolerance. It can rise dramatically, but it can also fall brutally. It is not the same as cash. It is not the same as a broad equity index. It is a volatile asset tied to liquidity, adoption, regulation, narrative, and macro conditions. The second area is hyperliquid and the hype token. The thesis is that hyperliquid may be one of the most underappreciated stories in crypto because it is not just another token. It is generating real volume, real fees, and real earnings, like activity within the crypto system. It has large total value locked, very high perpetual volume, deep liquidity, and an aggressive value. Accrual mechanism where a large portion of revenue is routed back toward buybacks. That matters because many crypto tokens have weak value capture. They create activity, but token holders do not clearly benefit. If a protocol generates fees and those fees support the token, the economic structure becomes more interesting. On top of that, hyperliquid is expanding beyond pure crypto pairs. It is becoming a venue for 24/7 trading of commodities, equities, indexes, oil, gold, silver, and other markets on chain. That transforms the narrative from crypto exchange to broader financial infrastructure. That is a much bigger story if people can trade oil, gold, silver, SP 500 futures, NASDAQ indexes, and real equities outside traditional market hours on chain. Then hyperliquid is trying to become a financial layer, not just a crypto product. Coinbase support for native USDC on HyperEVM adds another piece. It can make access easier and legitimacy stronger. Then there is HIP-4, the next catalyst in the source. It involves native permissionless prediction markets. Prediction markets have already shown large volume and growing user activity in other venues. If hyperliquid can capture a meaningful share of that flow, its fee base could expand again, and that could feed into further buybacks. This is the asymmetry, a platform with existing users, deep liquidity, high volume, revenue, and new product expansion may have more substance than a pure narrative coin. But there are risks. Validator decentralization is a major concern. If the network runs through a very limited validator set, it may be more centralized than long-term crypto purists want. That can raise credible neutrality questions, it can create governance or regulatory concerns, it can limit institutional trust. There is also execution risk. New products may not gain adoption, competitors may respond, volumes may fall in a bear market, token prices may already reflect optimism, regulatory scrutiny may increase. So the hype thesis is strong in the source, but not risk. Free. The third area is PER, the hyperliquid treasury company. This is not a crypto token. It is a NASDAQ traded company connected structurally to hype exposure. It holds a large hype treasury, has deployable capital, an equity line for further accumulation, and a share repurchase program. The reason this matters is that it may become a traditional finance wrapper for exposure to the hyperliquid narrative, similar in concept to how some companies became equity market wrappers for crypto assets. But PER is structurally different from many treasury companies because it reportedly sits on unrealized gains and has exposure to an asset with operating like economics through staking yield and protocol revenue dynamics. This can make it attractive when risk on conditions return and traditional investors want exposure without going fully on-chain. But there are risks. It trades around NAV, so there may not be a clear discount. Treasury companies can trade at premiums or discounts. They can become heavily narrative-driven. If hype falls, PER can fall. If the market loses interest in crypto treasury structures, the equity wrapper can suffer. So PER is a leveraged structural play on the hyperliquid ecosystem, but it should be treated as high risk. The fourth area is MicroStrategy. The thesis is simple. It is a regulated equity wrapper for Bitcoin. If you are bullish on Bitcoin, MicroStrategy can move with leverage sensitivity because the company holds a huge Bitcoin treasury and continues to target accumulation. This is not a normal operating company in the traditional sense anymore. It is a capital markets vehicle tied to Bitcoin exposure. When Bitcoin rises, MicroStrategy can outperform. When Bitcoin falls, it can also fall harder. Its capital structure, premium to net asset value, debt issuance strategy, and market sentiment all matter. The appeal is asymmetric upside in a Bitcoin bull cycle. The risk is leveraged downside if Bitcoin weakens or if the market reprices the equity premium. Again, the tool is not good or bad. It must fit the investor. The fifth area is a meme coin allocation through Pengu. Meme coins are the highest risk part of this framework. They are not based on cash flows in the way a business is. They depend on liquidity, attention, culture, community, branding, exchange access, and speculative momentum. They can move violently. They can also collapse. The thesis for Pengu is that every crypto bull cycle tends to have at least one high-cap meme coin that captures retail attention. Dogecoin did it. Shiba Inu did it. Dogwafat did it. The source argues Pengu may capture the next consumer crypto narrative because it has brand recognition, a strong Web 2 presence, and the potential to translate brand into token demand. The risk is obvious. Memecoin volatility, dilution of attention. Endless new coin launches, rugs and scams across the broader memecoin market, retail attention moving elsewhere for that reason. A memecoin allocation should be small and treated as speculative optionality, not a core portfolio. A watchlist position can make sense for traders. A retirement-sized position in a memecoin does not. The sixth area is BMR tied to Ethereum exposure and a public-facing figure who can promote the narrative. The source positions it as a possible next trade when markets return, especially if Ethereum and related treasury company structures gain momentum. The broader idea is that when risk on returns, equity wrappers and treasury vehicles tied to major crypto assets may run hard because traditional investors can access them more easily than on-chain assets. But this area is risky because many treasury companies rise and fall with narrative. If the underlying asset weakens, if the premium collapses, or if the promoter narrative fades, the downside can be severe. Again, watch list first, conviction after research, position sizing after risk assessment. Now, what ties all these plays together? They are not all the same asset. Bitcoin is the core crypto reserve asset. MicroStrategy is leveraged equity exposure to Bitcoin. Hyperliquid is a protocol and exchange, like ecosystem with revenue and product expansion. Per is a public equity treasury wrapper connected to Hype. Pengu is a memecoin and consumer attention play. BMR is a possible treasury or leveraged exposure play tied to Ethereum narrative. The common thread is risk. On liquidity, when markets stabilize and animal spirits return, capital can rotate into crypto and related equity wrappers quickly. The goal is to identify which assets have the best combination of narrative, liquidity, relative strength, value accrual, and catalyst before the crowd fully returns. But this is not a safe strategy. It is a high-risk asymmetry strategy. That distinction is essential. A person in wealth accumulation with high-risk tolerance may choose some exposure. A person near retirement, in debt without an emergency fund, or unable to tolerate drawdowns should be much more careful. No asymmetric opportunity is worth destroying your base. This is a principle. Protect the base first, then take intelligent risk. If you have no savings, no emergency fund, high interest debt, and unstable income, chasing speculative crypto plays is not investing. It is desperation. Desperation is a terrible investment strategy. Build the base, then seek upside. Now, the source emphasizes conviction. Conviction is what allows you to stay grounded when markets are turbulent. But conviction must be earned. It cannot be borrowed from an influencer. It cannot be downloaded from a thread. It cannot come from hearing someone else made millions. Conviction comes from understanding. You need to know the thesis, the catalyst, the risk, the invalidation point, the position size, the exit strategy, the time frame. Without those, what people call conviction is often just hope. Hope panics. When price falls, real conviction asks whether the thesis changed. If it did not, it may add. If it did, it exits. This is why research matters, not to create certainty, to create clarity. The world is changing quickly. AI is accelerating. Labor markets may shift. Bitcoin and crypto may continue integrating with traditional finance. War risk may remain. Oil may influence inflation. The Fed may react late. Earnings may support markets. Retail attention may return suddenly. Inside that environment, the person with no framework is reactive. The person with a framework can act. That is the difference. Now, there is one final layer in the source that matters beyond money. Grounding markets can make people unstable. Crypto especially can make people euphoric, anxious, greedy, regretful, and reactive. When money moves fast, the mind can become unbalanced. People begin defining themselves by account balances. They become addicted to charts. They lose perspective. They mistake profit for purpose. That is dangerous. Every investor needs something that grounds them. For some, it is faith. For others, family. For others, principles, health, discipline, service, or a long-term mission. Without grounding, market volatility can control your emotional life. A grounded person can make better decisions because he is not constantly being pulled by fear and greed. He can think clearly, he can wait, he can size properly, he can sell when he needs to, he can admit when he is wrong, he can handle both gains and losses without losing himself. That matters. Financial freedom is not only about money, it is also about not being emotionally owned by money. So as you build wealth, build inner stability too, because the next few years may bring some of the largest changes of this generation. AI may transform work. Crypto may reprice. Markets may melt up and crash. Oil shocks may return. Wars may flare. New opportunities may appear and disappear quickly. You need capital. You need a framework. You need conviction. You need risk management. And you need grounding. Now, let us bring this whole structure together. The market has recovered quickly because worst-case war fears eased. Earnings remained strong, and AI optimism stayed alive. But the macro risks are not gone. Oil remains the key transmission mechanism from conflict to inflation. The Fed's ability to cut depends on whether inflation remains contained. Earnings must continue to support valuations. AI must keep the future growth narrative intact. The Iran conflict must avoid a major escalation. Because of this, the best approach for many investors is not to wait entirely on the sidelines and not to chase blindly. It is to dollar-cost average into long-term asymmetric assets while keeping cash reserves for bigger dips. The long-term technological shift, especially AI, may create a future where ownership matters more than wages. If AI drives job displacement and governments discuss income support, then being an owner of assets becomes critical. The asymmetric opportunity framework is built on narrative, liquidity, attention, relative strength, catalyst, value accrual, and risk control. In crypto, the Source S watch list focuses on Bitcoin. Hyperliquid, Per, MicroStrategy, Pengu, and BMR, each with different risk levels and different roles. Bitcoin is the core. MicroStrategy is leveraged equity exposure. Hyperliquid is the high-conviction protocol and exchange infrastructure story. Per is the traditional equity wrapper connected to hype. Pengu is the speculative memecoin attention play. BMR is the Ethereum-linked watchlist idea. None of these are guaranteed. All require research, all require sizing, all require exit discipline. And the most important principle is that the market rewards preparation more than reaction. Most people are asleep when the work should be done. They wake up when the crowd arrives. By then, the easiest returns may already be gone. So pay attention now. Filter the noise. Watch the 5 needle movers. Build the watch list. Study the asymmetric opportunities. Dollar cost average where appropriate. Keep cash for dips. Avoid overtrading in choppy markets. Do not confuse conviction with hope. Do not use leverage unless you truly understand the risk. Do not chase because someone else made money, and do not let the market control your peace. The next phase of wealth creation may be enormous, but it will not be handed to the distracted, the reactive, or the permanently sidelined. It will likely go to the people who understand the forces, build positions before the crowd, survive the volatility, and know when to take risk off the table. That is the game. You do not have to love the game. You do have to understand it if you want to avoid being only a consumer inside someone else's economy. Own assets. Build conviction, respect risk, stay grounded, and prepare before the opportunity becomes obvious.